Now, as you have probably guessed, today we are talking AI stocks. AI has been a very hot topic over the past 6 months or so, and there is no wonder why. AI will change the world as we know it, and people who ride this wave of change will profit, while the ones who oppose it will get run over. Therefore, today we will have a look at two AI stocks that can help you ride this wave of change. The first one being Analog Devices, ticker ADI, currently trading at $172.39. Over the past 5 years, Analog Devices went up by 75%, and over the past 6 months, the stock went up by 5.11%. Now, over the past month, the stock is down by 4.58%, dropping from $190 per share to $172 per share. Now, the company has recently come out with their new ultra-low power AI MCUs, which run AI interferences hundreds of times faster than other embedded solutions. Their built-in neural network hardware accelerator practically eliminates the energy spent on audio and image AI interferences, which allows small machines like thermostats, smartwatches, and cameras to deliver the promise of AI. The company also anticipates a potential market of $6 billion by 2027, as they see an increase in technology complexity in various sectors. Now, to have a look at ADI in a bit more depth, we'll jump over to my stock valuation sheets. Right away we can see that the dividend yield for ADI is sitting at 2%, which makes the dividend payout to be $3.44 per share per year, with a trailing payout ratio of 61%. Now, this is not a horrible payout ratio, but I generally like the payout ratio for companies which need to direct a large proportion of their free cash flow towards innovation to be below 50%. Now we can see that the institutional ownership of ADI is sitting very high at almost 90%, and that the analysts currently project the price of $200 per share by the end of 2023, about $30 higher than the current trading price. Now the beta of ADI is sitting at 1.15, meaning that you will see slightly more volatility with the company than you would with the overall market. Now if we jump to the 9-pillar analysis right away, we can see that ADI is doing fairly well. First, we want the 5-year PE ratio to be sitting below 22.5, which would mean that ADI might be slightly undervalued compared to their earnings. In this case, ADI's PE ratio is sitting at 32.6, meaning that ADI might be slightly overvalued compared to their earnings. We also want the 5-year profit margin to be sitting above 10%. Currently, ADI's profit margin is sitting at 65%, which is a great profit margin for a company which operates in ADI's sector. Now, for the next three pillars, we want there to be an increase in net income, increase in revenue, and increase in free cash flow over the past 5 years. And as we can see, all three have been growing very well over the past few years. Now, generally, we want there to be a decrease in shares outstanding, which has not been happening in ADI's case. Not that big of a deal, as ADI is quite a new company. We also want the long-term liabilities of the 5-year free cash flow negative dividends to be below 3. Currently, this value is sitting at 1.59, which means that ADI can pay off all their long-term liabilities in about 8 to 9 years, while of course paying out a healthy dividend. Now, the price to free cash flow over the past 5 years is very similar to the 5-year PE ratio, sitting at a higher value than we want to see it, and there is consecutive dividend growth growing at about 10% annually, a very good dividend growth for ADI. Now, if we move to our first valuation model, which is the Grams formula revised, we take the earnings per share, the base PE, the 5-year growth estimate, and the growth rate multiplier, multiply that by the average yield on AA Corporation bonds, and then divide everything by the current yield on AAA Corporation bonds, which gives us an intrinsic value of $225.76, 24% higher than the current trading price of ADI. Now we can move to the next valuation model, which would be the discount cash flow model. We take the free cash flow over the past 5 years and calculate the average growth rate to be sitting at 26%. Now I predict a free cash flow growth rate of 10%, and using that growth rate I calculate the future free cash flow over the next 10 years. I then calculate the discount rate currently sitting at 10% for ADI, and using that I calculate the present value of that future free cash flow. I then sum all that up, add any cash and cash equivalents, subtract total debt, and get an equity value, which I divide by the shares outstanding to arrive at an intrinsic value of $155.39. Now for the next valuation model, the multiples valuation model, we will be comparing ADI to MU and QCOM, companies which operate in the same sector and have very similar structures to ADI. To these companies' stock prices divided by their earnings per share and arrived at their PE ratios. I then average out those PE ratios and multiplied by the earnings per share of ADI to arrive at an intrinsic value of $216.18, higher than the current trading price of ADI, indicating that ADI might currently be slightly undervalued compared to companies which operate in the same sector. Now we can move to our final valuation model, the dividend discount model. Here we plug in the dividend payout over the past 5 years and calculate the average growth rate to be sitting at 12.23%. I predict the growth rate of 10% into the near future, which would give us an intrinsic value of negative $420, which is due to the WACC being lower than the projected growth rate. Now for these situations, I have my alternative dividend discount model, which is based on the analyst projections for the stock price next year. And using this model, we arrive at an intrinsic value of $186.50, again slightly higher than the current trading price. Now if we move to our final valuation model, we averaged out all the models we did prior and arrived to an ultimate intrinsic value of $195.96, about 13% higher than the current trading price of ADI. Now if we plug in a margin of safety of 12%, that would give us an acceptable buy price at $172.44. If we try to plug in a margin of safety slightly higher, say 15%, which I generally like to go with, we would get an acceptable buy price at $166.57. Now the second company that has the potential to become the leader in AI development is Micron Technology, ticker MU, currently trading at $69.61 and up by almost 25% over the past 6 months. Micron Technology states that its innovations in memory chips will keep it several quarters ahead of competitors, as they are the leading industry in both DRAM and NAND technology. Also in January, Micron announced that it had begun volume shipments of their 176-layer QLC NAND chips. QLC stands for quad layer cells, where the rest of the chip industry is only making TLC chips, or 3 bits per cell. Currently it is looking good for Micron market-wise, but let's have a look at their financials, and to do this we'll jump back to the valuation sheets. So I have plugged in the ticker MU here, and as we can see, the current dividend yield for MU is sitting at 0.66% with a dividend payout of 0.46 and a trailing payout ratio of only 1.22%. So as we can see, the trailing payout ratio for Micron Technologies is significantly better than for ADI, but they also have a much lower dividend yield and a much lower dividend payout. Now if we have a look down here, we can see that the institutional ownership is sitting at 84% and that the analysts have a target price of $70 by the end of 2023, only $1 higher than the current trading price. Now the beta of MU is sitting at 1.41, slightly higher than the beta of ADI, which means that MU is quite a bit more volatile than the overall market. Now we can have a look at the 9-pillar analysis, and right away we can see that the 9-pillar analysis is looking better for MU than for ADI. The 5-year PE ratio is sitting below 22.5 and the price to free cash flow is sitting at nearly 20, or nearly below 20, sitting at only 21.69. Now the 5-year profit margin is lower than the profit margin of ADI, but it's still very high, sitting at 43.59%. We also have net income, revenue, and free cash flow growth rate over the past 5 years, which is great, and there is consecutive dividend growth of almost 15% year over year over the past few years. The long-term liabilities of the 5-year free cash flow negative dividends is sitting at 0.52, meaning that MU really doesn't have much long-term liabilities, being capable of paying off their long-term liabilities in about 2 to 3 years while paying out a decent dividend. Now we can jump to the Grams formula revised, and as you can see through the Grams formula revised, we take the earnings per share and we get an intrinsic value of $123.25, about 44% higher than the current trading price of MU. Now this very high intrinsic value is thanks to both the very high earnings per share of Micron Technology and the very high 5-year growth estimate. Now let's move to the next valuation model, and as we can see, we take the free cash flow over the past 10 years, calculate the growth rate, predict the present value of that future free cash flow using the discount rate, which is sitting at 10.40%, and we arrive at an intrinsic value of $65.94, about $4 lower than the current trading price of Micron Technologies. Now we can move to the multiples valuation model, where I'm comparing MU to ADI and NXPI. I took these companies' current stock prices divided by their earnings per share and got their average PE ratio, which I multiplied by the earnings per share of MU and got an intrinsic value of $69.23, only a few dollars lower than the current trading price of MU, showing that MU is currently potentially fairly valued compared to the companies which operate in the same sector. Now when we move to the dividend discount model, we take the dividend payout over the past 2 years and calculate the average growth rate. I then project a future growth rate of 9.9%, and using that and the WACC, we arrived at an intrinsic value of $88.98, quite higher than the current trading price of MU. Now when we move to our ultimate valuation model, we average out the Grams formula, multiples valuation, discounting cash flow valuation, and the dividend discount model. I will switch this back to the dividend discount model, and we get an intrinsic value of $86.85, 24.77% higher than the current trading price of MU. Now if you plug in a margin of safety of say 15%, the margin of safety I like to go with, we get an acceptable buy price at $73.83. Now it is tough to decide which company to invest into. ADI has higher dividend yield and a higher market cap, while MU has an overall higher intrinsic value compared to its current trading price. Personally, I'm waiting for both of the company's stock prices to drop below the intrinsic value with the safety margins we have calculated, and that's when I will consider investing into either of these companies. With that, if you enjoyed the video, make sure to leave a like and consider subscribing if you want to see more valuations like this. It also helps the channel out a lot.